Hello everyone, I am Miss Priyanka Sanjay Latte, working as lecturer at Mua Education Society's Mula Rural Institute of Pharmacy Sone. In this presentation, I am going to discuss topic that is banking and finance. Part 2nd. This topic we will discuss for second year D Pharmacy students. Content of presentation. What is meant by financial planning? Main aspects of financial planning. Financial policies. Types of finance. Sources of finance. Firstly, we will discuss for what is meant by financial planning. Finance is the lifeblood of any business. For smooth functioning of a business enterprise, finance is required. Finance is defined as the provision of money at any time when the business requires it. The purpose of financial planning is to ensure that adequate funds are available to the business firm for its proper utilization and administration. Main aspects of financial planning. First one, estimating the amount of capital to be raised for smooth running of business. Second one, determining the firm's and the proportionate amount of securities to be raised. Third one, laying down effective policies for proper administration of financial plans. Financial policies. First one, the total finance required for the business. Second one, the proper utilization of funds. Third one, controlling and handling the activities of financial collection and repayment. Fourth one, the determination of profit and its proper utilization. Fifth one, decision regarding the terms and conditions for the funds to be collected. Sixth one, the ways and means necessary for achieving target of financial planning. The success of an organization mainly depends on its sound financial policies, which have the following essential characteristics. First, it should be flexible. Second, it should be economical. Third, it should provide for maximum utilization of funds raised in business. Fourth, it should provide for sufficient cash in hand. Fifth, it should not fail under any circumstance. Types of finance. There are two main types of finance. First one, fixed capital. Second one, working capital. Working capital again classified into two types. In that first, permanent or fixed working capital, and second, variable working capital. We will discuss one by one. First types, fixed capital. The fixed capital of a business is invested in permanent assets such as land and building, plant and machinery, furniture, fixtures, etc. These assets are required in a business in order to carry on its activities. A business may meet its fixed capital requirements from a number of sources such as first, issue of shares. Second, issue of debentures. Third, ploughing back its own profits. Fourth, public deposits. Fifth, loan from specialized institution. Sixth, term loan from banks, etc. Second types, working capital. The working capital is required by a business for the purchase of raw materials and for meeting day-to-day expenses such as wages, salaries, rent, taxes, interest, etc. The working capital is also known as the revolving or circulating capital because it is invested, recovered, and reinvested repeatedly during the lifetime of the business. The working capital is of two types. First, permanent or fixed working capital, and second, variable working capital. In that first, permanent or fixed working capital, it is always necessary for a business to maintain a certain minimum level of stock of raw materials and finished goods and to pay regular expenses such as wages, salaries, rent, interest, etc. The permanent working capital is also needed immediately after the establishment of a new business. Second, variable working capital. The amount of variable working capital requirement depends on the particular purpose for which it is needed for the business. For example, if there is a sudden increase in the volume of business, further working capital is required to meet the demand of the business. The working capital is raised from the following sources. First, issue of shares. Second, issue of debentures. Third, ploughing back its own profits. Fourth, public deposits. Fifth, commercial banks. Sixth, specialized financial institutions. Sources of finance. There are two main sources of finance. First one, own capital. Second one, loan capital. Loan capital again classified into three types. In that first, long-term finance. Second, medium-term finance. And third, short-term finance. In long-term finance, issue of shares, issue of debentures, ploughing backs of finance, loans from specialized industrial financial institutions. And in medium-term finance, public deposits and mortgage. In short-term finance, trade credit, bank credit, installment credit, customers advance, own capital. It is contributed by the owner, that is sole proprietor, partners, shareholders, etc. It remains invested in the business so long as the business continues to exist. The return of such capital is dependent on the availability of surplus capital to be distributed. Loan capital. It may be raised from individual banks or financial institutions. It involving periodical payment of interest at a fixed rate and repayment of loan capital after the expiry of the stipulated period. The loan capital is available only against mortgage or the pledge of the property of the owner. The sources of finance can be classified into three parts on the basis of duration for which it is required by the business. These are long-term finance, medium-term finance, and short-term finance. We will discuss one by one. First, long-term finance. It remains invested in the business for a considerably long period, that is 10 years or more. The long-term finance is often invested in fixed assets such as land, building, plant, machinery, etc. It may be raised through the following sources. First, shares. Second, debentures. Third, ploughing back of profit. Fourth, financial institution. Shares. In a small scale business, the whole of the capital required by the business is invested by the owner, but on a large scale business, the ownership shares are issued to the public. The capital required by the business is divided into a large number of equal parts, and each part is considered as a share. Shares are of two types. First, preference shares, and second, ordinary shares. Preference shares. Preference shares are those which carry a preference both regarding dividend and the return of the capital. These shares are preferred by those people who do not like to risk their capital completely and yet want an income which is higher than that if invested in some other schemes. The preference shareholders get a fixed dividend from the profits, and the remaining profit is divided among the ordinary shareholders. The preference shareholders get a fixed dividend in case of winding up of the organization. Ordinary shares. These are also known as equity shares. The ordinary shares holders are the real owners of the organization because the company is controlled by them. These shareholders have voting rights to elect the directors of the company. The dividend on these shares is paid after the dividend on the preference shares has been paid. These shareholders have a risk because they get their claim only after the clearance of all other claims. These shareholders are generally paid a higher rate of dividend. The rate of dividend on such shares depends upon the amount of profits available and the policy of the directors of the company in this regard. Debentures. A debentures is a document or certificate issued by the company acknowledging loan and also gives an undertaking to repay the specified borrowed sum along with interest to the debentures holder on a prescribed date. The debenture holders are the creditors and not shareholders. They carry on voting rights, and interest on a debentures is payable periodically until the debenture matures. A debenture carries a fixed rate of interest. Ploughing back of profit. It means to reinvest the profit in the business. The profit earned by the business organization is not distributed or only partially distributed among the ordinary shareholders or partners. The money which is saved in this manner is reinvested in the business. This fund is generally known as reserve fund. Financial institutions. There are various financial institutions which have been set up by the centers and state governments to provide long-term and medium-term finance to industrial concerns. These institutions charge a fixed low rate of interest. The various financial institutions are: first, Industrial Finance Corporations of India (IFCI). It was established in July 1948 with the objective of rendering financial assistance to industrial concerns, public limited companies and cooperative societies for a period not exceeding 25 years. Second, Industrial Development Bank of India (IDBI). It was established in July 1964 with the aim to coordinate, regulate and supervise the activities of other financial institutions such as IFCI, ICICI, UTI, LIC and commercial banks. It also provides direct financial assistance to industrial concerns by providing loan on long-term basis. Third, Industrial Credit and Investment Corporation of India (ICICI). It was established in January 1955 to provide medium and long-term financial assistance to industrial units in the private sector. Fourth, Industrial Reconstruction Bank of India (IRBI). It was established on 20 March 1985 with an aim to nurse the sick industrial units by providing short-term loan to them. Fifth, National Small Industrial Corporation (NSIC). It was established in February 1955 as a private limited company with the main object to promote and protect the small industries by providing to them financial assistance for the purchase of machinery and equipment. 6. State Financial Corporations. These were established under the State Financial Corporations Act 1951. The main objective was to provide financial assistance in the form of loans and advance and direct subscriptions of shares, stocks, debentures and bonds. 7. State Industrial Development Corporation SIDCS. A number of state governments have established their own industrial development corporations to accelerate the growth of industrial development corporations of industries in their respective states. They grant loans and advance to the industries. They also subscribe to the shares and debentures of industrial concerns. 8. Unit Trust of India (UTI). It was established in 1964. The basic objective of UTI is to stimulate and pull together the saving of people belonging to middle and low income groups, to enable the investors to share the benefits of investment in the overgrowing number of industrial concerns in the country. Second, medium-term finance. It remains invested in the business for a period between 3 to 10 years. Medium-term finance is generally used to implement expansions, extensions, or modernizations programs of a business. It may be raised through preference shares, debentures, term loans from banks, financial institutions, already discussed in the long-term finance, and public deposits. Public deposits. The undertaking which intends to raise public deposits approaches the public through an advertisement in the press. The advertisement highlights the achievements of the company and its future plans and invites the investors to deposit their savings with it. Generally, money is borrowed for 1 to 3 years and the rate of interest on borrowed sum depends upon the length of period of deposit. The interest is paid periodically or at maturity along with the amount of deposit. Mortgage. It is a secured loan borrowed from a bank, insurance company, or any other similar agencies. The loan is sanctioned against mortgage or pledge of the property of the company. The same is returned back on payment of loan within the agreed time. Third, short-term finance. It is raised for a period of less than 2 years. The short-term finance is used to meet seasonal or current expenditures such as purchases of raw material, payment of wages, and other recurring expenditure. The following are the main sources of credit raising finance for short term. First, trade credit. Second, bank credit. Third, installment credit. Fourth, customers advance. In that first, trade credit, the credit is granted by the manufacturers and wholesalers to the retailers to help them for the sale of goods. The usual duration of such credit is 30 to 90 days. It is granted to the company without any security. The credit is granted only on the basis of goodwill and financial standing of the borrower. No interest is charged for this. Only the price charge is slightly higher than the cash price. Second, bank credit. Commercial banks generally provide loans for short periods. They provide term loan, overdraft, cash credit, and advance in the form of a loan against securities. In order to get a loan from a bank, either the merchandise is placed in the custody of the bank or collateral securities are kept in the custody of the bank. Third, installment credit. This is commonly called consumer credit as it is generally used by retailers for selling consumers articles like refrigerators, washing machines, television sets, fans, etc. on easy installments. This installment includes interest on unpaid sum and are suitably spread so as enable the borrowing firm to meet them out of its current cash flow. Fourth, customers advance. Sometimes a firm meets its short-term financial requirements through customers advance. Such advance represent a part of price and carry on interest. The period of such credit will depends upon the time taken to deliver the goods. Thank you.